My name is Cohen. I'm the author of Winning the Trading Game and Trade Like a Pro. I've been involved in the business for 18 years, both as a brokerage owner, a CTA, and also as an interim editor for Futures Magazine. It's real simple. I'm just looking for a trend. We can get fancy and we can talk about Elliott waves. We can talk about all kind of whatever we want to do, oscillators, the like. But the reality is, as a retail trader and even as a professional trader, all I want to do is kind of catch the bulk of the move. And when I see breakouts, I take advantage of those. When I see breakdowns, I take advantage of those. And so I just get in when the market tells me to get in, and I get out when the market tells me to get out. The key moving average has always been the 50-day moving average for me. There's some other additions that we put in, like 3 days after it breaks the 50-day moving average, whether or not it's a key, continue to buy. But when the market breaks the 50-day moving average and then sustains that, then you're able to see a new trend. That's all we want to do is trade what's the trend and what's the counter trend. And so we use the 50-day moving average, I use the RSI to give me a little idea of whether the market's oversold or overbought, to kind of tie that in. And then I also play around with Bollinger Bands and the average true range. So, but when it comes down to it, it's always the 50-day moving average that I'm looking for first. Well, the first thing, and I've been advocating this for a long time, every trader needs to keep a journal. A lot of people kind of recreate history for themselves when they're successful, and then even when they're at a loss, they make up a story around it. It's always best to maintain a journal to decide, so you know why you got into a trade, why you got out of a trade, and start accumulating those so that you realize that one trade should never make or break you, but you should also have something to look back on and realize, okay, this is where I was following hunches, I wasn't following my system. Second key thing that every trader needs to maintain is a system that lets them out of it. As Pareto's principle says, 80% of our efforts produce 20% of our results. And 80% of people's efforts is in technical analysis right now. They focus on how to get into the market. But 20% of their efforts is really where the profit is, and that's getting out. And the majority of traders don't know how to get out of the market. Whether they're successful or losing, they tend to either panic when they're losing, or they tend to not appreciate when they're winning. And so what happens is, no matter what, they end up giving money back to the market. I guess the final thing that everyone needs, I think daily everyone needs to do, is just stay on top of what's happening, but they don't have to actually trade. There's 3 ways you can be in the market. You can be long, short, or flat. Not enough people take advantage of being flat in the market. Well, it's everything. Gold is right now a very volatile commodity. Everyone around the world is running to gold as soon as the currencies move down, or they're running to gold because they think that Armageddon's hitting in some part of the world. So the reality is, if you want to avoid the deep fluctuation against you, but you want to maintain the positions, you have to have options in place. Options allow you to ride out any movements. And you brought up synthetics. People don't realize that you can actually buy an option as what I call a hard stop. You pick a price, as close as possible to your entry point, and you buy it, and you can hold on to that position until the option expires, which could be 2, 3, 4 months from now. And what that does is it gives you a chance for the market to breathe, so that all those big fluctuations that are going to occur, because we know they will, you can ride them out because the trend is still positive. The key of it is, I think a lot of people confuse money management with risk management. I believe money management is actually how you deal with the cash you have on hand. So that determines what markets you're going to be in. If you only have 10,000 or 15 or 100,000, you'll buy T-bills based on that, and you'll trade against the T-bills. You'll do different things with the actual capital, and that's money management. It's basically how you deal with your money, win, lose, or draw. Risk management really is about maintaining as little loss as possible. And a lot of traders don't capture what that means. And that means that you have to utilize all your tools, and you have to actually go beyond stops. All the sophisticated traders I know, all the CTAs I know, don't just use stops, because stops can be broken through. They're not hard and fast rules. But if you use options, or you use spread trading, or you're using butterflies or any of these other things, that means you're really into minimizing your loss. And that's the name of the game. As often often as you can, minimize your loss for the long haul, the easier it's going to be for you to have capital when those times you're going to be successful.